Holistaplan presents Tax Time with Jeff Levine. Let's talk taxes.
Hi, everybody. This is Ben Birkin, the Vice President for Customer Success and Engagement here at Holistaplan. I'm replacing Roger Pine for this particular episode. Roger is in places undisclosed doing unspeakable things. So I have graciously volunteered to take over. I'm joined, as always, by Jeff Levine, Chief Planning Officer, Strategist at Buckingham Financial Advisors.
And then I do planning stuff.
You do planning stuff, and you're the chief, right? I think once we emphasize the chief part, anything that comes after that is just gravy, right? But Jeff also lives a double life and helps us out as our tax planning strategist here at Holistaplan. So Jeff, as always, welcome. Thank you for your time.
Yeah, thanks for having me, Ben. I appreciate it.
Absolutely. Today, we're going to talk about a topic that has come up a lot, probably over the last month or so, as it relates to some of the legislation that was put up by the House Ways and Means Committee. That legislation had a ton of stuff in it involving higher marginal rates, different ways of dealing with capital gains. But one of the things that caught a lot of advisors' attention that we're seeing internally with advisors who use Holistaplan has to do with ROTH conversions, starting potentially next year. But before we get there, before we talk about the Ways and Means Committee, let's just set up right now the concept of a ROTH conversion. Jeff, just walk somebody through what that might look like and why they might do it.
Sure. I think there's actually two things that we should focus on here. One is what is a ROTH conversion. The other is like the notion of after-tax dollars, right? And kind of how do these come into existence and what are they? Because the ROTH conversion at its height is a way of, if you think about it at a very high level, I should say, it's a way of kind of transforming it. It's tax alchemy, if you will. It's taking money that is going to be forever taxed and moving it, as my good friend Ed Slott says, into an account that is never taxed. Now, of course, you have to pay the tax at the time to do that. So there is a, pay the piper sort of situation here. But it's modern day tax alchemy. It's taking the pre-tax account and taking it into a Roth account. So whereas a Roth contribution is kind of fresh money that's never been in a retirement account before, that's getting input or getting put in, I should say. I'm a little bit backwards today. The conversion is taking already existing retirement account dollars and making them Roth. Now, the other key here is that this is looking at preventing the conversion of after-tax dollars. And a lot of people have asked me, well, Jeff, aren't Roth IRAs themselves after-tax dollars? And yes, technically they are, but that's not what's being referred to as here. What they're talking about are the after-tax dollars in pre-tax accounts. So this would be non-deductible contributions to a traditional IRA. So someone who is an active participant in a plan or their spouses and their income is too high, it takes two of those. You got to have both. You got to have high income and either you or your spouse or both of you are active participants in an employer plan. The other thing to consider there is after-tax dollars in employer plans, which are not quite as common, but still you see them from time to time. And there, what we're simply looking at is taking advantage of the difference between the money that has gone into the plan from things like salary deferrals and company matches and profit sharing. And let's say like the salary deferral limit is here, right? And you've added on another, 19.5, let's say, and you've put in another 8,500 of employer contributions just to make math easy. That gets you to $28,000. Well, this year, the overall limit for a 401k plan is $58,000. So simple math tells us 58 minus 28, well, there's $30,000 that could be added to that account. But how, right? We've already maxed out our deferrals. We've already gotten everything. I can't go to the employer and say, give me more money. So the way to potentially do that would be to fill it up. I guess you could, but
could always try, right?
Yeah, try it. And pay for effort, right? But the way to fill that up essentially would be with after-tax dollars. And this would be additional money contributing from your salary going into the pre-tax side of the plan, as effectively the plan equivalent of a non-deductible IRA contribution. There are a bunch of rules about who can do this, and the plan has to allow, and it has to meet testing requirements. That's not our issue for today. Our issue for today is that the current proposal would prevent those after-tax dollars from being converted to a Roth IRA period, end of story, no matter what, who you are, how much you make, how little you make, whether you're married, single, from Mars or Earth, doesn't matter. No more after-tax dollars being converted beginning January 1st of next year. So that is the proposal at hand.
Right. And so this is kind of a big change, especially for financial planners who have been going through the strategy of, I don't think we're supposed to call it this, but everybody calls it this, the backdoor Roth IRA contribution.
Yeah, you
right,
can. Even Congress in its notes says, it's called what is commonly called the backdoor Roth IRA. I mean,
we said it enough that we've gained acceptance, right? But
right.
I know for a while we were advised not to call it
right?
that. Yeah, exactly. We were advised not to call it that. Don't call attention to it. But I mean, that's what it is. But it was a way of getting around the income limit for higher income folks who made too much money to just do a regular Roth IRA contribution, right? This was sort of a way to get money into a Roth without being able to get money into a Roth.
That's right. Assuming that someone didn't have a bunch of other traditional IRA money, because then you'd have to deal with the pro rata rule. But assuming that wasn't the case, and a lot of high income individuals, retirement accounts are concentrated in plans, or if they are high income, it's probably because they are working, they have a higher chance of having access to a plan. Maybe they were able to move all their pre-tax IRA money into that plan. If there's no other IRA money, what we've been able to do for years is to put the money into a traditional IRA, have it be non-deductible, but who cares? Because we're gonna turn around and convert it. And now we convert that money. It's not taxable at the conversion because it's converting all after-tax dollars, and poof, magically, it's kind of almost the same as if it was a Roth IRA contribution to begin with. I mean, very minimal difference there in terms of its treatment. Only in very minor circumstances, if you took distributions early, et cetera, would there be any difference? And even that would be minimal if you converted it before there were earnings. So it truly was, again, the term backdoor, even Congress, or rather the IRS itself said a few years ago, an IRS spokesperson said, we don't really love that term, right? Yeah. It was part of a larger conversation.
I don't know why.
And then, of course, on the plan side, if you don't like the backdoor Roth IRA, you're certainly not going to like the mega backdoor.
That's right.
Roth
it's
IRA.
The bigger backdoor. Right. Yeah.
Like we've just opened up a even larger, that loophole, we kind of just blew it wide open, and we did even more of it in the plan side. So that is what would be prevented there. So the key, I think, from a planning perspective, right? Because the other question I'm getting a lot is, well, what does this mean for planning going forward? And obviously, as we said, beginning January 1st of next year, it means you can't do it anymore. Right. But what that effectively means is 2020 may be your last hurrah. And if you want to do your, and again, May was still, pending legislation, not legislation, or proposed legislation, not legislation. But I think this is likely to end up in the final bill. I think this is really likely to end up in the final bill. If that's the case and you want to do it, and this is your last hurrah, well, one, if you've got after-tax dollars in either of those types of accounts, pre-tax traditional IRA, or you've got a 401k, et cetera, and you want to move those, now is the time to do it by the end of this year. But there are also a lot of people who kind of habitually wait until tax time to make their IRA contributions, right? It's almost like Pavlov's dog. They submit the stuff to the CPA and they go, oh, right, I've got to make my contribution for last year, not proactively as we would encourage, because that extra year of tax deferral is actually meaningful if you do it over a number of years. But in hindsight, right, almost like now I'm going to contribute for last year, and you've always been able to do that until April 15th. Well, you would still be able, under the proposed legislation, to make the non-deductible IRA contribution January 1st through April 15th of 2021. But what are you going to do with it?
Right. It's going to sit there now.
Right. Now you can't. So now you're stuck with it, which, may be what you want, but for a lot of folks is not the intended result. And the difference between doing it on January 1st and doing it December 31st and, converting it is quite significant. So effectively, there's now this artificial deadline, if you will, for these non-deductible 2020 contributions that we have to kind of act as if it exists, right now. So getting those dollars in sooner rather than later can make sense. And of course, if we're going to do this at the very last second, on a December 31st conversion, I would try not to have the contribution go in right then too. I would be doing that now.
Yeah.
Really like right now, hang up, click the X as soon as we're done, not until we're done though, but click the X when we're done.
State of the end.
Yes, that's right. State of the end, and then go call your clients right now.
So we're actually almost at the end, but I think this has all been a really good setup for what precipitated this as a topic, which is we've been getting these questions on the Holistiplan side of, well, does this really mean that if I have an IRA, and we'll just stick with the IRA, that has $1 of after-tax basis, that I'm not allowed to do any conversion? Because I think if you read the legislation, I don't think it says this, but I can see how somebody might interpret it that way, right?
Yeah, I've been hearing that question a lot too, right? Is this stopping anybody with an after-tax amount of any sort in their account from being able to contribute convert any part of their account? And again, I agree with you. I think you could take a really aggressive reading and read it that way. I don't think that's the intent here. I don't think that's how IRS would interpret it. I think what they're literally saying is you cannot convert the after-tax dollars. So effectively, what would be spelled out in I would assume regulations at some point, but I mean we're 2+ years into Cure Act, which was kind of meaningful, and we don't even have regulations for that. So who knows? But I think what would effectively be the case here is another exception to the pro rata rule, and this is certainly not unprecedented. We've got several of them already. For instance, a qualified charitable distribution, something we encourage, very much for individuals who are charitably inclined and are 70 and a half or older. That is only made of pre-tax dollars. You can only do it with pre-tax dollars. No after-tax contributions can be used. So that's one exception. A rollover from a IRA up to a plan, right? Typically, we're thinking about it the opposite way, but you can go from an IRA to a plan. Only pre-tax dollars can be rolled into a plan. So that is, that is another exception to the rule. And also, kind of an oddball one, a QHFD, a qualified HSA funding distribution, that one-time ability to take IRA money and fund your HSA contribution for the year. That too is also subject to an exception. It can only be done with pre-tax dollars. So I think it'd just be another one of those. Ultimately, it's not 100% clear from the legislation, but Ben, I don't do this often because I really don't want to have to do it, but this is another one of those. I think this might be the third time I've said it this year on a different subject. I will eat my weight in tax code pages if I'm wrong on this one. So
you heard it here first.
That's right. So, and Ben, it's more tax code pages than I'd like to admit. So I'm hoping I don't have to do that.
I mean, if you've said it 3 times, I mean, you're wagering quite a lot there.
Yeah, the good news is I've been right on the first 2. The bad news is if I tempt fate for too long, it's not like Congress and the IRS are known to be super consistent. So I am kind of playing with fire here. But hey, listen, life's short. Got to have some
That's fun. Right. We're rolling the dice. Well, I'm glad to be here as part of the roll the dice. So, Jeff, thank you so much, as always, for your contributions, your wisdom. I know that we appreciate it. I know that the folks that are Holistiplan users and basically everybody who looks to you for this type of advice appreciates everything that you share with us. So thank you very much, everybody, for watching, and we will see you next time.